I'm curious. It looks like inflation and interest rates are likely to continue to rise. What do you think that means to the broader markets and for Elliott's business in particular?
Well, you know, I think we've all enjoyed the benefits of low rates for a long time and ultra accommodative monetary policy globally. Anybody that's managed to put risk on the page in the last 13 years, but more specifically in the last 18 months, has been well rewarded. I'm not sure it's all genius. I think those tailwinds have made us all look good. But now I think the cycle is evolving. And so what does that mean? You know, if you think about just taking a step back, I don't know if you've seen these numbers, household wealth has increased by about $5 trillion for the last 5 quarters, $5 trillion. So I think we're at all-time highs for household wealth to nominal GDP, which is like at 6.25 times. At the same time, you know, we have household wealth at like almost a 50% allocation to equities. So you start to think about, is there real sensitivity to rates? Is that wealth imperiled? You know, Bank of America recently did some work on the S&P and figuring out what the duration of the S&P was, and I think they came up with 35, 36 years, and composition makes a difference, a lot of high growth companies. But then Goldman did the same analysis for the Russell 1000 and came out with a 22 duration for equities. Well, if you start fooling around with the numbers, you know, 100 basis point move for a 22 duration zero coupon is a big move. You know, it's down, you know, 20%. And I'm not saying that the market's going to go down 20% tomorrow, but I am saying that there is sensitivity. Where that attachment point is, it's a whole nother question.
Do you have any sense of, you know, when that might occur, or, you know, why the market's not reacting at this point?
Okay. I think it's really, really difficult to know. Right now, it feels like we're in this Goldilocks moment with the Delta variant behind us, people coming back to value, rates rising. I mean, just in August, you know, rates were, you know, the 10 years at 110, we're up 40 basis points or so. And you haven't seen any real move in equity. So it's really hard to know when that comes. But right now, with earnings growing, I think, you know, and again, you know, with the recent past that it only has paid you to buy the dips, you know, I think that mentality is kind of still in full swing.